right, traders, we're here with episode 2, AK-47 and Kevin Avery, otherwise known as KA-47, right? Episode 1, what are small caps? Episode 2, we're going to talk about like when and how to trade small caps. There's a lot of different ways, methodologies of making money in this space. The long, the short, long and short, being objective with your trading. What are your thoughts, Josh?
Yep, same thing. You got to think about, kind of like we talked about the first one, your thought process changes throughout the years of doing this. And then where are you trading? That's the key. You're trading in pre-market, before the opening bell. You're trading after the opening bell where all the chaos and the volume is at. Or you're going to wait a little bit and kind of wait till maybe an hour or two after the opening bell when the chaos calms down, or even into power hour. Are you trading the PRs in pre-market and after hours? And that's, we talked about that, I think, hinted on in the first one. You got to figure out who you're going to be as a trader. And that's where I found my little niche, so to speak, and where I found my bread and butter, which is pre-market into the opening bell, and then just calling it a day. But that's definitely one thing, when to trade them, because a lot of traders want to trade all day long. It's like a video game when you pull up Grand Theft Auto and you just got your new video game and you want to sit there and play it for 12 hours straight. That's not how the stock market works, and that's not how, if you're going to do
beat it in one day. I want to get funded in one day. That's when catastrophe happens. You got to scale back a little bit and thinking via time frames on your account. Like, let's not go for getting this thing funded today. Let's think on a more intricate level. And there are so many different times to trade. I mean, there are a lot of funded traders with TTP who have found success in pre-market and only trade in pre-market. I had a trader who said they told their broker, lock me out once the market opens, and they actually got funded with TTP, just trading pre-market. They do so well there. That's where they found their edge. So I think the evals are very important, guys, to learn where are you finding most of your success. And this can all be tracked, whether that is in pre-market, open, or into that power hour. I actually wanted to show CWD, which did a crazy power hour move the other day, and go over that for you guys. Let me pull that up just one second. All right, here's CWD. This was a power hour move. If you're a power hour trader, you remember this the other day?
Yes.
And the psychology behind this, guys, is, pretty much at the market open, it tried to, you see the upper wick out of the gates? It tried to have a little breakout. It was met by resistance, profit taking, faded, and went sideways. Now, the idea for this is it kind of goes sideways, shorts start accumulating because it looks weak under that purple line, the VWAP. And then what you need is volume. Volume is so important on this name. That's actually the next banner here. There has to be volume in trading. Day traders are hunters of volatility, and we're managers of risk. That's what we are. So for this ticker specifically, you needed the volume to come in a day. That's what you're looking for. We went over last episode, price action. Price action is king, and that's certainly what we're looking for. We've seen these squeezes in power hour actually quite frequently for some of these plays. Now, again, some of them do fade all day, but if you're just waiting for the confirmation over anticipation and that volume coming through, there's money to be made on that squeeze, because buyers stepping in, shorts having to cover their positions, getting a massive squeeze into the close.
Speaking of, yesterday, Money Mitch, of course, we were live with him and his play with IPDN. That was another play that actually did it right after the closing bell and after hours, did the same sort of thing. And so I literally brought that up today, and I saw that today. I was like, oh man, Money Mitch is probably money today, and loving that squeeze, but that's exactly what you're looking for. And it can happen, and that's why they call it power hour. And of course, there's after hours where that squeeze can continue to go as well. You got to keep your eye on that. Again, so time frames, when are you trading? And secondly, now to this next point, volume, because you don't have volume, like we talked about, volume equals action, action equals money. So you have to find the volume and stick with that. When it fades, so does a ticker, and you can leave it alone unless you're shorting, but a lot of the time it still leads to erratic action, and so you have to find plays with volume.
So you found consistency in pre-market and market open. Tell me a little about that. Have you tried trading, into the close or after hours?
No, never. So at first, we talked about this actually yesterday too as well. We have to journal our trades. We have to track them and go over when are we good at trading. And I saw myself, and I think I talked about this. I got into broadcast journalism. I wanted to be in radio or TV. I wanted to have a 4-hour day like my dad did. He worked radio 6 to 10 a.m. I was like, man, I would love to be done every day at 10, right? And so I never wanted to see myself as trading past lunch into power hour. So I never liked that, never got that. I understood why traders wanted to trade all day long, but I didn't have that. I wanted to get to the stock market, get to my job, make my money at my job. Again, jobs you've had in the past, I've always had this as another analogy. If I've ever shown up to any job I've had in the past, a normal 7, 8, maybe 9-hour day that I know is coming ahead of me, I got to stay till close. If I was 2 hours in and they're like, yeah, you know what, Josh, AK, you've made your money. I'm going to go ahead and pay you. Go ahead and head on out. Whoa. 2 hours in, you're going to give me the, okay, you sure? Yeah, here's your 8 hours of pay. I would take my money and leave. I wouldn't care about being there the other 5 or 7 hours, right? So you got to think about that in the stock market. And so I never wanted to be there later in the day. And so I started to see a lot of success after the 30 minutes after the opening bell when I was new. And all you new traders, pay attention to that. You're not going to probably be very successful right at the opening bell. There's a lot of chaotic movement, a lot of volatile movement. Sit back, as we say, be a stock sniper and wait for trades to come to you. And as years have gone on, I got closer and closer to trading at the bell. And then it was 3 years in that I finally, or 3 to 4 years in when I started trading in pre-market. And it comes back to shorting, because what do you see a lot in pre-market? A lot of what we've talked about recently, mob shifting. And so when one play pops up, it consolidates, moves out to the right. Another new play may come out with news and a PR. It takes the mob majority of buyers away from the first play that moved up. So what does that first play do? After that consolidation builds up, we talk about it tapping on that door, eventually putting enough books on a shelf. That shelf's getting too heavy of books. It cracks and you get a great short. And so that's where I've found success. And using those tiers, whether I'm getting bounce plays, which we'll get into strategies here in just a minute, what we're trading as far as in market. But in pre-market, a lot of the time I'm looking for either the breakouts for new highs or that secondary short for sure once a new play comes around.
So pre-market's very interesting because it almost seems like the high frequency trading isn't very active in pre-market. So you get much cleaner moves. The algos, what seems to me like they turn on at market open, and that's they have that increased volatility. They're looking for penny moves.
Right.
And so you don't get quite the continued, like at pre-market, we see a lot of clean moves. That's what the traders have been saying, that have been seeing a lot of profitability and consistency trading pre-market, just cleaner action. There's no hunt stopping because you can't play stop orders in pre-market. So that could be why, the high frequency trading isn't very active there too. It's a little illiquid. A lot of large institutions actually don't start trading until the bell. Yeah. And so you just have less liquidity, which is going to equal just less traders, cleaner setups, cleaner moves versus the market open. Now, in my own personal experience, at market open, I've tended to just kick back a little bit, 10, 15 minutes with the increased volatility. Sometimes for me, it increases just the risk inherently with some of the setups because I like to trade hangovers, and those are tickers. They're bought up from the prior days, and I like to short them near the open, but less size because there is a little inherent risk. We're going to get into sizing, actually. Sizing is very important. This hand specifically, I treat like a pocket pair ace hand. So I've seen it work consistently over time via journaling. And what I do is I'll apply a little bit more risk to this hand. I short this setup that's hanging over. It's the one we talk about, the mob shifts. Josh mentions that. And so the mob is elsewhere. And I'm shorting the ticker that was shiny like 3 days ago that nobody's looking at, right? And so
another good analogy would be like someone's party down the street and now they're over here and the rager's there. Now you just go to the party down there, right?
Yeah, exactly. But I love what you were saying about the time. The 4 hours you want to get in, get your money and get out. The thing I would caution newer traders is, but we all start this way. We want to make a lot of money in a condensed period of time. The love for the game is what sustains us. The ones that I've seen make it and they thrive, they love trading and they focus less over time on the money and more on the process. So instead of I want to make a ton quick, eventually over the years, you're going to say, I want to stick to the process in my trading plan. And money is ultimately a byproduct of trading well. And you're going to stick to your system. And regardless of a red trade or a green trade, it doesn't matter. You're not results oriented. At a certain point in your trading career, the green's not going to have the same effect on you. The red may even bring you some euphoria knowing that you adhere to your trading plan. You always got to have a trading plan. And that leads us to the next point, which is strategies. You have to have a strategy. Predefine the risk before you enter the trade. What's unique about trading is we get to see the pattern develop before we put our money in. It's different from slot machines. Slot machines, you put the quarter in, you spin the wheel. It's like, what's going to happen? Trading, we see the pattern. We apply as much money as we want to this pattern. And so there are a lot of different edges to trade. And over time, what you're going to have to do is, as a trader, is figure out what is your edge? Where do you find most consistency? Is that in pre-market, the open, power hour, and stick to it, because over trading is a problem too for newer traders. We want to avoid over trading. We want to stick to the system. What system works best for you? Now, you can trade multiple edges. Josh and I can talk about that. The same poker analogy. I may play a pocket pair ace hand and apply more chips on the table, but I may also play pocket deuces, but just apply less risk to that trade. It could be, for example, like a breakout setup, but the ticker's already up multiple hundreds of percent. We actually saw that this morning with a ticker, and it turns into a fake out breakout. So what may work most of the time is going to work less just because the ticker's already overbought and up several 100%. So you got to be careful with those.
100%. And then just get into this if you want to. I'll do my one ticker that I show off today, and I think you're going to maybe even look at it too as well. But it's AIHS. This is definitely a play that A is providing you volume and going to give you consistent volume, but then different multiple setups that you can trade on this. So AIHS, beautiful mover today. And this was actually one of those ones that you could take out of the gate, in my opinion. And I actually called this live in my lobby, and someone took it and wrote it all the way up today. And I was so proud of him. I wasn't looking to trade this. It was right before the opening bell. He says, AK, Josh, where do you see a trade on AIHS? And I said, hey, in my opinion, there's a bounce plate about the 320, 325 area. And there was a gorgeous bounce, right? And then it just shot up from there. But that's what we end up trying to find, right? We're trying to find support areas for bounce, which you get one out of the gate. And then you start finding that staircase move up as you get there, right? And then you find this overall gap fill if you go to past chart history and you start doing a little due diligence that we talked about the first time around, right? And then you wait for the trend crack and the reversal toward the end of that run, and you finally get a nice, safer short, right? And so you just sit back and just wait. And there's that nice, beautiful gap fill territory right there. That
big upper shadow right up to that ceiling. Absolutely gorgeous. So what I love about this, Josh, is you took the ride up, and I took the ride down. I mean, my edge is looking for shorting these plays into euphoria at resistance. I'm going to show you guys that chart real quick. Here's AIHS, my chart on this. Guys, I was real thrilled with this. I mean, that ceiling worked perfect up there. Shorting it a couple times right there. The power of scaling against the 850 ceiling and taking profits on the way down. And then the beautiful thing about AIHS was it formed a head and shoulders pattern. Left shoulder, right shoulder in the 750s, and another elevator down move on these tickers. I'm a big fan of the elevator down. I love shorting for that reason. I'm looking for the euphoria. So I'm not trying to predict volume, guys. We just went over volume. I'm not trying to predict volume. I'm finding the volume. Where is it at? Where's the price action? And then taking a predictable setup and moving along. I'm not trying to gamble. I'm trying to take the predictable piece and move along to the next ticker. And again, one of the things I've been seeing with a lot of traders where they've been messing up, they've been blowing up accounts recently is overstaying your welcome. If the trade doesn't work, if it's blowing through that ceiling, and let's say I short it and it blows through, don't just sit there and overstay your welcome and just keep trying and trying and trying. No strategy is a certainty. It's not a guarantee of working out. We can trade our edge and have the probabilities on our side. It's a positive EV, expected value.
Back to what you're just kind of touching on, that find the trend within the trade, right? So we'll go and touch on that real quickly. So if you're trying to trade bounce plays and you're not seeing them, well, don't trade the bounce play. If you go for a bounce play, it doesn't work. Why would you keep trying it over and over, correct? And so here we go again. We're bouncing at this 320-25 area over and over and over before we get to the opening bell right here, over and over and over. You can see where my crosshairs are at. And then boom, quick feel for everyone that I was alerting this. It was up in this area. I said, I'd watch for a quick pullback to 320, 325, and you're probably going to get a good dip and rip. And that's what you get. You got a good dip and rip. You can look that strategy up. It's a great strategy here for small cap plays with low float plays. And then you just ride that wave up. And then what happens, you're looking for dip buys along the way. Where I last got filled, and again, what going back to what Kevin, K.A. over there was talking about, I'm going smaller on the way up. So as we're moving up, we're over 100% now. I took this, but I was only in 1,000 shares. I took this dip back down to a nice support consolidation area. I was in 1,000 shares, took that up. And then we go to new high of day. I said, guys, the safe bounce, in my opinion, just like it was right below 6, it's going to be right below 7. This time I only go in 500 shares just to get a little more piece of the pie, right? Why? Because it's risky at that area, but I know it's a great. It's a pair of jacks. It's some queens. It's not my ace, no, but I know I'm working with something good right here, and I can work with that. So
you know what's funny? We didn't talk about this at all. I'm going to show my chart. I did the exact same thing. I was heavier when it hit that ceiling, and then I sized down to half of my share size on the head and shoulders to reduce the risk. You know, you want to preserve your capital, and if the setup's not as clean as the other one, reduce the risk a little bit. You know, go in with less chips on the table, but still making money. I love that. We did the same thing. It's the power of scaling. It's the next topic we're about to dive into right now. So explain, for scaling, how do you do that? Do you take single entry, single exits? Do you scale along the way? Do you scale out into the profits? How do you go about that?
I would say most of my setups, because I wait for my setups, and I feel, in my opinion, a 90, it's a 90-10, as I call them, 80-20. And I have very good, strong, like, again, we go back to the pocket aces. Like, okay, I know that's what I want to trade. The majority of the time I'm trading that. So I'm usually, if it's a bounce play, like what I did earlier, I'll put two or three areas and orders in. If I want to go in 1,000 shares, split that up to 2 orders. If I want to go in 2,000 shares, split that up to maybe 2 or 3 or 4 orders, right? And find an area so I get filled. It isn't a bad idea to put it all in one area, but sometimes you just may not get filled. So I like to surround that. Same thing for you, and like shorting up top, which we could have right there, and I'm up that $8 area and filling that hole. you put some at 797, put an order at 807, put an order in 817, kind of surround that area to make sure you get filled properly. But and then same thing for scaling out. When I move into my territory, I find my areas that I feel like, say, if again, we'll just, for example, if you're going for a short, I look down in that chart and I find areas that we could possibly bounce at. And I know, me being a pretty good bounce trader, where those could be at. And so that's where I want to take my profit on the way down. And usually, generally, most of the time where I scale out, you see a little bounce there, right? Which is fine for me. And that's what I like to do. And the same thing on the way up. Hey, if I'm going for a long, where do I want to scale out? Well, into resistance where it could fail and knock me out. And so do I ever average into a trade here and there, but it's usually large cap runners like Google. I did that last week when I was live on the stream with you guys. And it's just an all-day chug-a-lug mover, whether it's driven from a PR or it's just chart. Not too much in small caps, so I ever add in. It's usually a defined area that I get in, and then I'm scaling out and taking profit along the way. How about you?
Yeah. I like to scale up. So starting with a feeler position, a starter, it's just a position to just keep your interest on it. Like this morning, there were so many different plays popping off. There was so much going on, so I may throw like 100 share feeler on this just so it has my interest and attention, and then kind of size into the ones that are working or confirming for you.
Right.
And the ones that aren't, you take them off. It helps me, by the way, throw this in there for free. It helps me when I have multiple positions on and I can just see what is working and what's not working.
Right.
When I tunnel in on one trade and I have like one trade, one P&L right there, the ego kind of starts taking over. I may take that trade a little personally and the bias kicks in, and I want to keep it as objective as possible when I'm trading. Absolutely objective as possible. The beauty of this ticker we trade today is we could have been both as objective as possible. We could have literally taken the ride up, the long and the short of it. That is the beauty of trading, guys. You can make money on both sides of it with your edge. Tickers that are flatlining, there's no money to be made. If something's selling off, there's money to be made. I mean, you can short it. Tickers go up, you can long them. You don't need a perfect all or nothing trade with scaling. That is one thing I do like about scaling. Let's say traders, you want to apply $100 risk to a trade. That's pretty much 100, 200 share position, but you can break it up. So you don't have to have the exact perfect entry. And that's what I love about it. You can start it with 50s, throw another 50, throw another 50. You need to piece it up so it doesn't have to be exactly right at this entry or I'm right out. It's right or right out. There's no flexibility at all. It provides a sense of flexibility that I like as far as scaling goes. Now, on the profit side of things, like today worked great. I had an IPDN short and the thing tanked like several points and I just left 100 shares on it just, to play around with and got, add the wallet. Even 100 shares there are multiple points, $200-$300. I like to leave a piece. I call it leftovers to just set a trail order, like give it 100 ticks of room and then just let her work. Let her rip tater chips, what I call it. Leaving a trail works very well for me. What are your thoughts on leftovers? Do you normally leave a little piece to work or you you
try to, if you get, now it's not going to happen all the time, but when you get trades like today where you get those multiple point movers, it's moving, you get in a good entry, you got to start having that
confidence, that
like you were saying, yes, and we'll have a runner there. And what happens, like you're talking about early on too, with kind of just to back up on that, was you don't have to be precise, like you were saying, like everything has to be a perfect entry, a perfect exit, and I got to get out here and I got this full $100. No. So that's why I like having certain, like when you are scaling in or scaling out, it's not this perfect science. It's close enough, but then you're happy with that and you can just repeat that day in, day out. It's just too many people that I see try to be perfectionists of, and just like a quick example, target of $5, they're in at $4.50. The play goes up to $4.96, $4.97. Oh, I want $5, but they don't take the profit and it comes right back on down. They never take any profit. It goes red. Then they do the whole hold and hope strategy. Don't do that. Take your profit.
Got to take the profit.
Your face right there, you're reeked of it.
Yeah, the holding and hoping. I've seen too many traders blow up utilizing that strategy. It's not very effective, guys. Let's segue into the mistakes to avoid, and that's certainly one of them, holding and hoping down here. If you ever find yourself in the prayer stance, just liquidate your positions. Lord, please send it just to break. And that's how we operate, right? It's like, I just won't break even. I'll be happy if it just comes back and you take me out break even. I'll never do that again, I promise. And then your whole account, you get blown. So there's many mistakes to avoid. I listed 3 here. You don't want to chase. That's the fear of missing out. There's multiple fears to go over. Over trading, that's certainly involving your ego. You want to trade. You want to be in these trades. You think because you're a trader, I have to be in a trade at all times, when in fact, the best traders will tell you sometimes the best trade is waiting for the example we just showed you, AIHS, waiting there for that ceiling to hit. I mean, you would have been sitting here for an hour, but then Once you get that position on, it's money. So oftentimes patience, Josh and I spell it with a PAY, does pay very handsomely. Thoughts?
Yeah, pays off. You get the big three right there in the head. And just things that you would think about not to or to do would be don't still at, to avoid, quit staring at your P&L. I know too many traders out there, once they get in a trade, they're staring at the P&L. That's why actually, if you look at any of my charts, I don't want to look at it. I don't have it up on Thinkorswim anymore. I have it. Even on Trade the Pool. I mean, when I'm in my trade, I go back to just looking at the chart on Thinkorswim because you get to eye on that P&L and things get a little juicy in your brain and those emotions start rolling in your heart and then you're on a roller coaster. So don't do that. And the other thing mistakes to avoid would be to not journal or track. You need to journal and track your trades and go over what you're doing every day. So that would be a mistake on yourself not to do that and do your own. That would be a disservice to yourself. So I would add those two in for a big five. That would, be a big five that I see a lot of traders doing. The three you mentioned, the two I mentioned. And if you just focus on those five that we mentioned, the three that KA mentioned, the two that AK mentioned here, I promise you your trading, your journey and career will be much better if you avoid those things or the things not to do with the disservice with not tracking and journaling. So make sure you pay it.
You can make trading as hard or as smooth as you want. That's what they say, right? Choose your hard. It's hard to wait patiently to get involved in a trade, but it's also hard to get in early and to be down thousands of dollars. Choose your hard. There's a choice in trading. You get to choose which hard you want. Risk management.
On the novice level, please.
Yeah, exactly. All right, lastly, guys, risk management is key. Got to have risk management. You got to be able to take small losses. If you can't take small losses, you're going to inevitably at a certain point take large losses, and that's certainly what you want to avoid. Everybody's going to have red trades, but they don't have to be so deep in the red. We need small losses, small wins, and big wins. Avoid the large losses at all costs. Be rigid with the rules, traders. Flexible with the profit expectations. I love to always just have an OCO set. One cancels the other. So you got the stop in, you got your profit in, and whichever takes you out, and don't adjust it mid-trade. Don't adjust it. I'm always setting a stop when I get into a trade. The mental stops, they can be dicey in small caps, especially if you get tickers that are just zoom straight up. Chat room jumps in, it's jumping up a point or two. You go deer in headlights if you're short on the ticker or long, whichever way it goes, and it doesn't end well. So I like to always have a stop set, especially the lower the flow, because of the higher the demand, you get very large rips on those tickers. So always set a stop, guys. Be rigid with those rules. Allow some of the profits to work out for you, and you'll be good to go. Josh, final thoughts?
Yeah, same thing. I mean, you got to have the stop loss set in. Just too many people don't set either a trailing stop, OCO. I'm good with mental most of the time. That's just where I've trained my brain to get to. Of course, I've been doing this for a while, so it's one of those things where I can fly my own jet now. Early on, you're not even in the cockpit. You're watching them fly, right? So set the stop loss and put it in 100%. Because that's the one thing early on a lot of traders just don't do is understanding the risk and managing that. And always a lot of the thing I do just real quickly to make it easy, and it's a very easy process, is I always find my first target early on. Whether it was 15 cents away, it was 20 cents away, and I would set my stop loss to that. And I would go down to my chart and find something that was okay. If I wanted a 25-cent target, I would go down, if I was trying to go long, I went 25 cents. So I would go down about 12, 15 cents, 10 cents and try to find something in that chart that would help, whether it was a moving average, it was a VWAP, it was actual chart, it was old resistance that would be new support. And that's lasted me all the way to now, to where I have, of course, an 80% win rate from just sticking to that, where I was like, here's my 2-to-1 ratio. Take profit here. There's my stop loss. And then you get the 2-to-1 ratio, but then that's when you start getting 3-to-1. You start getting 4-to-1s, and your RR is so much better and higher.
Yeah.
So, but manage that early on and find that stop loss and make sure you're sticking to it.
Absolutely. Something I've been working on here lately is really letting those winners run, and even sizing some of these winners, allowing for maximum profitability. They say pigs get fat and hogs get slaughtered, but in trading, when you have a setup that's working, sometimes you got to go for it and let that winner work out for you. Don't take it off too early. Letting a piece work helps out with that fear. I had a couple trading fears, fear of losing money and the fear of being wrong. And so that's why I started taking a piece off, because it's like, I know I'm green now. I can adjust my stop, so I'm going to be green regardless on this trade, and let a piece work for me. And that's just emotionally based. Based on those fears, but it has worked for me to allow some of these winners to work out.
Yep. And just to add on to that one last bit, don't get frustrated, traders, when you get out of the trade and it keeps running with that, whatever direction you're going in. Let it go. Don't double dip, as I talked about it. You double dip the chip. don't double dip the chip, okay? Wait for another setup. You got your dip in, let it freaking go.
Absolutely. I mean, frustration is a sign of what? It means the ticker's not doing what you want it to do anyway. So maybe it's invalidated for you. The market's just printing information. We take the setups.
Right.
It's not supposed to be painful information. Oftentimes we'll get into the trade. We're perceiving it as painful information. So we try to find unpainful ways of perceiving it. So it's like, okay, let me look at the fundamentals here, and then let me look at other indicators. Maybe this is a good trade, even though you're deep in the red. So yeah, absolutely. Try not, guys, just take the trade, embrace the risk, and accept the results. Guys, that is going to be episode 2, and we're going to do episode 3 next week. So stay tuned for that. Traders, we will see you in the next episode.